Hello and welcome. In this video, we will answer the question, what is an IPO? Alright. Along with learning what an IPO is, we will also learn a few terminologies related to the stock market. Alright. Now, for us to understand the concept of an IPO, we will take a story. And this story will be connected to future lectures. Alright. Now, two friends decide to start a company that manufactures coconut oil. Okay. And they have a name in their mind for the company. And the name is Oli. Okay. Now these two friends who will be starting the company or who start the company are called promoters. Alright. Promoters. So promoters are the ones who start the company. Alright. So these two are the promoters of Oli. Now, they have not started the coconut mill yet. They just have an idea to start. They have worked out everything on a piece of paper and they know that they need 10,000 rupees to start this company. Okay. I have taken a small number here so that it will be easy for you to grasp. Alright. So according to their calculations, they need 10,000 rupees to start this company Oli. Okay. Now, let me name this person as A and this person as B. Okay. So this is B and this is A. Person A says that he has 4,000 rupees and is willing to give it to start the company. Person B says he has 2,000 rupees and is willing to give it to start the company. Alright. So 10,000 rupees are needed to start the company. 4,000 is given by person A, 2,000 is given by B, and in total that comes to 6,000 rupees. Okay. So 10,000 minus 6,000 is 4,000 rupees. They need 4,000 rupees more to start the company. Alright. Now, where can they get this money from? They can get this money from a bank. Right? So what they do is they go to a bank. They go to a bank. Now when I say that they go to a bank, they are going on behalf of the company. Alright. What company? Oli. Now where is this company? On papers. Alright. So on behalf of the company, they go to the bank and ask for a loan. It is not these two who are taking the loan. It is the company that is taking the loan. Okay. Now the bank checks the records and goes through the procedure that it normally goes through before giving the loan. And then the bank says that it can give a maximum of 2,000 rupees. Alright. it can give a maximum of 2000 rupees. Now this 2000 rupees is called as debt. Okay, debt. So debt is the money that we owe someone. Now if these two friends take 2000 rupees from the bank, then they owe the bank 2000 rupees. Correct? So this is their debt. Now, going to the math. They needed 10,000 rupees. 4,000 rupees was given by A. 2000 rupees was given by B. And 2000 rupees by the bank. So in total, they have 8,000 rupees. And now they are short of 2000 rupees. If they get this 2000 rupees, they can start the company. Alright? So to get this 2000 rupees, what do? They divide the company into 4000 pieces or 4000 shares of 2 rupees each. Alright. They wanted 2000 rupees and so they divided the company to 4000 shares of 2 rupees each. Now, why 4000 shares of 2 rupees each? 4000 multiplied by 2 is 8000. 8000 rupees is what they wanted. Correct? 4000 rupees from A, 2000 rupees from B, and 2000 rupees is what they want. So 4000 plus 2000 plus 2000 is 8000 rupees. This 2000 is given by the bank. Correct? So they need 8000 rupees and so they divide the company into 4000 shares of 2 rupees each. Alright. Now do not worry much about this. It will make sense slowly. Okay. Now they could have divided the company into 8000 shares of 1 rupee each. So 8000 multiplied by 1 is 8000. Okay. They could have divided it into 4000 shares of 2 rupees each. 4000 multiplied by 2 is 8000. As long as the number comes to 8000, they could have divided it anyway. They could have also divided it into 2000 shares of 4 rupees each. 2000 multiplied by 4 equal to 8000. Alright. They could have done it in multiple ways, but they chose to do it in this way. Okay. Now remember that the shares have to be equal and distributable. That means they cannot just divide it into 2346 shares or 4394 shares or 8434 shares, for example. It doesn't work like that, alright? They have to be equal and distributable. It must be distributable among the public, correct? Now once again, do not worry too much about this. Just know that they divide the company into 4000 shares of 2 rupees each. Alright. Now, A has given 4000 rupees for the company and B has given rupees 2000 for the company. Right? So A decides to keep 4000 rupees worth of shares for himself, and B decides to keep rupees 2000 worth of shares for himself. So that is 2000 shares plus 1000 shares. So out of the 4000 shares, 2000 shares are kept by A for himself, and out of that 4000 shares, 1000 shares are kept by B for himself. Alright? And now the remaining 1000 shares are given to the public, which they can buy at the price of 2 rupees each. And the public buys it. Alright, the public buys it, and the friends get 2000 rupees. After which they start the company. Alright. Now, when the company offers to sell shares of its company to the public for the first time, then it is called an IPO. Okay? An IPO is the first time a company issues shares to the public. Alright? Now, when I say public, it is not for people like you and me. We will learn about this concept later. Okay? Now, this is when a private company decides to go public. Alright? IPO means that a company's ownership is transitioning from private to public. Alright? So previously it was a private ownership, meaning only the two friends owned the company. And now it is transitioning to public, meaning the public can also be the owners of the company. Alright? And for this reason, the IPO process is sometimes referred to as going public. Okay? And when the company offers its shares for the very first time, we call it as initial public offering. Alright? Or an IPO. So we will learn about the markets in the next video probably. Do not worry too much about this. Alright. So this is an IPO. What is an IPO? An IPO is when the company issues shares to the public for the very first time. It happens only once. Alright? Yes. Now, let us proceed and learn a few more terminologies related to the stock market. We have something called as shareholding. Okay? It is a very simple concept. Out of 100% of shares, how much is 100% in our example? 4000 shares. Out of 4000 shares, 25% of the shares are held by the public. And so, 25% is the public shareholding. Meaning, 25% of 4000, which is 1000 shares, are with the public or are available to the public. Okay? And out of the 4000 shares, 3000 shares are held by the promoters. Who are the promoters? A and B, the two friends. Correct? So 75% is the promoter shareholding. Alright. Now there is no difference between the shares held by the public and the promoters. It is one and the same. But since the promoters have a larger percentage of shares, they own more of the company. Okay? They have a greater say in the company. They have a greater stake in the company. Alright? Apart from that, everything is the same. Okay? Now this is for our example only. This 25% and 75% is only for our example in this video. Alright? This can be different for real companies. Okay? Every company has a different percentage of public and promoter shareholding. Okay? Next, we have debt equity ratio or debt to equity ratio. Okay? Now to understand debt to equity ratio, we must know the capital structure of the company. So the capital structure of the company is 10,000 rupees, or 10,000 is the capital of the company. Correct? In our example, it is 10,000 rupees. And out of this 10,000 rupees, equity is 8,000 rupees. Equity is essentially shares. Alright? Do not worry too much about this. Just know that equity is like a share. It is not equal to a share. It is the stake in the company. But think of it like a share. So 8,000 rupees is the equity. And debt is 2,000 rupees. Alright? Or how much the company owes the bank is 2,000 rupees. How much the company doesn't owe anyone is 8,000 rupees out of 10,000 rupees. Alright? Or how much money the company belongs to the owners is equity. Okay? Now, debt equity ratio is 2,000 to 8,000 or 1,000 to 4,000. If you simplify this further, it is 1:4. Alright? This is debt equity ratio. And by knowing the debt equity ratio, we can know how risky the company is. Okay? So we will learn more about debt equity ratio in a different video. Alright. Now if the company's equity was rupees 5,000 and the debt was 5,000 rupees, then the debt equity ratio would have been 1:1. Whereas if the equity was 2,000 rupees and the debt was 8,000 rupees, then the debt is more and the debt to equity ratio would have been 4:1. Alright? We use this while reading the financial statements. Okay? So the big idea here is the higher the ratio, the more debt the company has relative to its equity, which generally means higher financial risk. Whereas lower ratio is equal to safer company. Alright? Yes. Once again, do not worry much about this. We will learn about this in detail in a different video. Alright?